You are listening to Keystone's Stock Talk Show, episode 183.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to be with you again this week. I am just a static image this week as I am coming to you live from the LD Micro Conference in beautiful LA. We will chat about the event next week as it is just kicking off. In our News of the Week segment, we look at an open letter to Zuck as Meta shareholders tell the founder to limit spending on the metaverse. Big Chinese tech drops again this week as Chinese President Xi Jinping tightens his grip on power in the country. The UK getting a new prime minister, and it's considered a market-friendly choice. And finally, comments from the former Bank of Canada Governor Stephen Poloz on walking the line between taming inflation and not crushing the economy. In our Your Stock Our Take segment, Aaron answers a listener question on Innergex, Renewable Energy Inc., symbol INE on the TSX, an independent renewable power producer which develops, acquires, owns, and operates hydro facilities, wind farms, solar farms, and energy storage facilities. The stock has pulled back quite a bit and has an attractive yield. A listener asks us if we see it as a buy at present. In our Stars and Dogs segment, Brennan's Dog of the Week is PyroGenesis Canada Inc., PYR on the TSX, which designs, develops, manufactures, and commercializes advanced plasma processes and sustainable solutions which reduce greenhouse gases and are economically attractive alternatives to the conventional dirty processes. His Star of the Week is Propell Holdings Inc., symbol PRL on the TSX, an online financial technology or fintech company with a proprietary online lending platform. Brett hits the mailbag this week and answers a listener question on Nuran Wireless Inc., symbol NUR on the CSE, a leading rural telecommunications company that meets the growing demand for wireless networks coverage in remote and rural areas around the globe. Let's get to the show. I welcome my co-hosts, Aaron, and the Killer Bees, Brennan and Brett. How are you guys doing?
Doing well.
Great. Yeah, I'm expecting, I don't know why, I'm expecting that ratings are going to go through the roof for the show. There's just something that looks
This is really
a little
funny.
different about it. It just looks a little bit different, and I like it. Whatever we're doing, we got to
The
keep
lowest
doing
rated show of all time. That's all. That's my call on this one.
We just got to keep this going, whatever it is.
Get my ugly mug off there, and it's going to be great for ratings, I'm sure. Now, I've heard that we got some crazy weather. I was in Anaheim over the weekend, and it was got up to 30, 32. But you've got snow. We've got snow in Alberta, and we got proof of it here. And so snow in Saskatoon.
Yep.
Correct.
Yeah.
There we go.
Wow.
Outside Brett's mansion.
Yeah, about half a foot. Oh yeah, huge.
Yes. and Brennan, his picture of him, of course, just on a golf course.
Yeah.
Mm-hmm.
What are these guys are just living the life, eh?
Yeah. I mean, I'm looking forward to the
any
snow
castles out there or anything?
No,
Brett?
no.
Yeah.
I'm still
Where's
a little
your
bit
snow
behind.
angel, Brennan? There's Brennan.
There's mine. Yeah, that's the golf
weak.
course behind.
That's weak. Yeah.
Mm-hmm.
Hey, well, it's snow. It's snow. But yeah, I need to put on my winter tires still. I don't think that that's something that you guys are familiar with in Vancouver. Maybe you are, but I wouldn't know since I'm.
You change your tires? That's weird.
Yeah, I do change my tires, but I haven't changed them yet. So, probably have to do that pretty soon before I get stuck. And
so how deep do you
we have to put chains on the way to Whistler? Sorry.
Yes, yeah. No, that's true. We do have to on the way to Whistler. How deep do you expect the snow to get, Brennan?
I mean, it depends. Like, a a few feet, probably. I mean, over the winter.
Yeah.
Like this golf course here that's pulled up, I actually have one of my friends lives on the other side of this golf course. So, many times I'll be walking home late night through a foot of snow across this golf course. And one time, actually, my ears got so, I guess, wind burnt and even just like frozen, that the next day I woke up in my bed and my ears were just burning. I'm lucky I didn't lose them, but they are pretty big. They are pretty big. Yes.
That's nice. So how many times winter do you come out of your igloo there?
Well, it depends if I have to feed the sled dogs or not, and but I keep them on a pretty good eating schedule. So, just kidding. No,
That's good.
I go to the gym quite a bit and whatnot, but I will say it is nice to be nestled inside in the warmth. Well, it is snowing. Did that sound bad?
They just don't understand.
They don't
Yeah,
understand.
no, it's true.
Yes.
Oh, that's cool. Well, yeah, no, it was 30 plus degrees.
Stop
and
bragging.
we were at Disneyland for a few days. And I'll tell you, like the amount of money that you now spend at Disneyland, Aaron was again just looking at Disney as a stock, as we want to do all the time. And yeah, I mean, they really ding you for everything down there now, and it's no wonder their results are looking pretty strong. So,
Yeah.
oh yeah, there's you got pictures up there.
Oh,
now.
come on. I thought we were going to not have this. On
There's
our
usually
podcast
one
this week.
of the back of Eric's head, but it's impressive to see.
Mhm.
It's funny in that picture because he's almost as tall as Aaron now, but you can't tell. Like I think he's might be taller than you now. With
Oh,
his hair up
possibly.
the
Yeah.
top.
Last time I saw him, he was quite tall.
It's crazy, man.
Well,
Anyways,
I think you just got to cut off, a portion of that picture and it would look great.
yeah,
Yeah.
maybe the right hand side, right? Just get-
Yeah.
There you go.
Zoom in a bit.
There's 3 people in there that
Oh,
can stay.
that's hideous.
Oh, that's good.
I'll have to
Perfect.
cut out Eric too in
Well,
that
hopefully you can get the video of Eden in there with her lightsaber. If maybe we get that later, because I know everybody wants to see that, but I do. Also, she will be happy if I show it. So I'll get a win, right? Yeah.
Yeah, I was a
But
little
just-
bitter.
okay, well-
We're
on the
preparing.
on the topic of Walt Disney, just
Disney.
as a stock, just so we can just chat about that a little bit. Ryan was talking about the many creative ways. I've been down there myself as well, but Ryan was talking about the many creative ways that Disney has figured out to separate people from their money, right? And in the past, of course, you would pay a fairly high ticket to a theme park and you'd be able to go to the rides, right? Well, Disney, you get your all access pass, but it's not really all access. You can pay a little bit more. There's more. It's more for the genie. Is that right, Ryan?
Yeah.
And that's so that you can plan your rides, right?
Yeah, and you get like one, like it used to be called a fast pass, but it's like a lightning lane. Every like 2 hours, you get one to avoid the lineups. But yeah, it's only one every 2 hours, right?
Right.
But,
so in any event, it's another way of them to get money from people,
and there's
right?
also
And then for really great rides,
yeah,
you also have to pay more. So like Rise of the Resistance, for example,
which is
you're paying an
awesome.
extra $20 to $30, which I've done it. I would highly recommend. But looking at at the company, stock price has been cut in half over the past year. It continues to be a great brand. And the analysts, the financial performance has been very strong. The analyst results expecting about $3.93 in earnings per share is the consensus, up from $2 last year. So from a valuation perspective, starting to look interesting. And this is a company we've talked about to our clients in the past as something that's at the top of our monitor list. But given that Ryan just went down there for research purposes, we'll have to have a meeting and see if there's potential to upgrade.
Yeah, I think $3 of that $3.93 was from my family spending down there over the past weekend. So, yeah, it's true. No, I wanted to say I was on Mike Campbell's Money Talk show over the weekend. I really enjoyed talking to Michael again. I think it was a good segment. Brennan liked it.
Yeah,
so,
great conversation.
That's like saying my mom liked it though, almost. But Brennan
that
said
makes me hate it.
I thought it was a good segment. Talked about a couple companies, and we talked about our upcoming seminars. And by the way, like the tickets are going tremendously well. You can tell that people, want advice, want our take, which is nice to see. On the seminars are called "Building a Stock Portfolio During a Bear, Profit in the Boom." So November 2nd, 7 p.m. Pacific, November 8th, 7 p.m. Eastern. It just talks about essentially reviewing how to position your portfolio for 2023, broad risks and opportunities. The 2022 drop, North American stocks, it marked the worst drop in 52 years. So how did we get where we are today, where the valuations are, and what to do going forward, how to build that simple 15 to 25 stock portfolio. That is the live webinars. We also have a special VIP package in Vancouver and Calgary where you can attend those events, get all our research for a year. Those are 5 hours on, I believe, the 5th and 6th, starting at 11 a.m. local time. And we will, have lunch there. Lunch, especially with Aaron Dunn. He'll sit down with you. Probably Brennan will actually spoon feed people lunch. I think that's what will be going on. Oh, we can't
Sure.
promise that. I'm sorry.
No,
As
and
much
yeah,
as everybody wants that. Yeah.
and I
But
will
we
say,
have 5 hours for this event to really go through.
Yeah.
Some tools, some great tools that we've learned over the past 25 years in the markets, and helping people set up their portfolios. On one hand, if you're just building a portfolio, how do you go about that? How do you start? What is the process? What type of companies should you put in there? Questions like asset allocation, risk tolerance. These things are things that we're going to address, can help people figure out. But also people that have an existing portfolio and they don't really know what to do with it. Like, how are you going to review that portfolio and fine tune it and optimize it? That's another subject that we're going to cover as well. But we have a good amount of time that gives us the ability to really kind of dive deeper into some important critical areas that people really need to know.
Yeah, and tickets have been selling very well for that too. I will say that, we just have a few seats left available for both Calgary and Vancouver. So good turnout there. It'll be nice to actually get in person and shake some hands, especially from current clients. And, I haven't really been at a client
fist
event
bump
like
if
this.
you're more comfortable with that.
Or fist bump, whatever you're into. Ryan will probably be offering hugs, kisses on the cheek, maybe. We'll see.
That's getting weird. Okay, what is happening? I'm just kidding.
Just kidding. But yes,
probably.
make sure you get your tickets to those events before they sell out. There are just a few seats left in each city.
It is true, and with that, the VIP events we're limiting it. So we just announced those last week, and it looks like we'll have full rooms in both cities, which is really cool. Really great to see.
Yeah.
So let's get to our. I think we're good on that. We'll get to our news of the week.
Yeah.
Correct.
Let's do it.
Well, let's start with Meta shareholders. Can we do that, or what do we got? Yeah, Meta. We got it. Perfect. They were telling Zuckerberg to stop spending on the metaverse. There was an open letter. Just some background. Shareholders are kind of restless. Meta stock is down around 61% in 2022 alone. So Altimeter Capital Chair Brad Gerstner, sorry, I can't speak right now.
There you go.
In an open letter to the company, said Meta has too many employees and is moving too slowly to retain the confidence of investors. The Meta investor essentially recommended a plan to get the company's mojo back. I'm not sure if that's a complete plan, but I think there was a plan offered. But it includes reducing the headcount expenses by 20% and limiting the company's pricey investments in the metaverse technology to no more than $5 billion per year. I believe they're spending in the range of $10 billion per year right now. So, yeah. So just to give you some color, at the end of the second quarter, that company that penned the letter, Altimeter Capital, held more than 2 million shares of Meta. So that would be around 260 million investment in the company. Still small in terms of the entire value of the company, but there's a growing discontent in Meta. And I think the letter is a vote of less confidence about the company's ambitions in the world of virtual and augmented reality. I'm sure that Zuckerberg, Mark, would say that this letter is likely focusing more on the short term, and Meta is thinking 10 years out. I mean, that's what they've been looking at. But, the stock market is a little myopic. It does focus quarterly. And, the quarters have not been stellar of late for Meta. And, there's further concerns on the horizon in the near term. So we could discuss.
Yeah, that's the question. I mean, near-term growth for the company. Like we did include Meta as one of the companies, just as a monitor report in our larger US technology SaaS report. And that was the thing when we came to Meta. It's, the next big thing for Meta is the metaverse. And, we wrote here, the financial problem is it is a decade away from Zuckerberg's admissions. So, he's even saying that we are potentially a decade away of this bearing fruit. So, I can understand why investors are, a little hesitant. And we've gotten a lot of questions in the chat room with clients about metaverse asking, well, the stock's pulled back a lot. Is it now the time? Well, looking at the growth, it may pay to be a little bit patient here, because who knows when the metaverse will bear fruit or if it will,
Yeah,
it's
sure.
I mean, it's one of those things that's impossible to say when you're investing for something that you're expecting to happen 5 to 10 years out. But it's interesting because it was 2 weeks ago I was talking with my cousin, and he's certainly somebody who would be a primary target market for the metaverse. I mean, he's millennial. He's very into what's going on in tech, keeping up on it, and just kind of being like one of the innovators. And he was talking about the metaverse. And about how, given the amount of money that Facebook has invested into it or Meta has invested into it, that it's just been a complete flop, right? With embarrassingly low number of daily users. And so it doesn't surprise me now to hear, as Ryan said, investors are always going to look like quarter to quarter. Zuckerberg may very well be right, but he renamed the company to Meta. So obviously this is the direction that the company is going to take. It's not, we think that there might be an opportunity to invest a couple $100 million in this area. It's like they see this as the future of the company. And one of the big things that we have, one of the big concerns that we've had when it comes to Meta and Facebook is just that, social media can be a very trendy thing, right? And I know that for the younger generation, they're not into Facebook, right? They're into Instagram for sure, which is owned by Meta. But their TikTok is the big one. Yeah, TikTok, Snapchat. But so it's just a matter of now can Facebook or Meta, invest in other things or acquire other things to always have, the top or the cool social media platform. And that's what they're trying to do. Obviously, it's going to take a big investment and there's going to be a lot of risk. Just for context, last quarterly report that the company put out, revenue was flat. Earnings per share were down about 32%. So, the investors aren't
and that's
happy.
The issue. It's we look for growth at a reasonable price. Maybe historically it looks like a reasonable price. Are you seeing growth in the business right now? And that's where it doesn't meet our criteria.
And I'm not somebody who really I'm not going to be somebody who really gets to know the metaverse very well. That's not something that I, for myself, want to explore. Not so much for in entertainment, at least not as like an early innovator. So I have no idea if their investments are going to be successful. It really seems like a bit of a crapshoot. So, it could very well be, or it could not be. You just never know. It could turn out to be absolutely incredible for the company long term, or it could be the end of the company long term. It's very difficult for anybody to say at this point.
And I know there was some pushback. Just one last thing. I know there was some pushback on Meta for making Instagram and Facebook too much like TikTok. Like I think it was Kim Kardashian and Kylie Jenner came out and said, make Instagram again. And then they were complaining that Instagram is trying to be TikTok. So you can see Instagram and Facebook have been pushing towards these short videos, which is what has the young generation's attention in this day and age. Even, YouTube is doing the same. But, there are some growing pains as they're trying to, retain, those eyeballs on the screens and whatnot. So I know that there has been some pushback there, but we'll see what happens.
Yeah, well, Kim knows, so
yeah,
it's true.
Yeah.
So no, let's shift gears to Alibaba, Tencent shares in Chinese tech giants plummeting to start this week, down after Chinese President Xi Jinping tightens his grip on power there. The moves and the stocks come after it's this paved the way for an unprecedented third term as a leader for Xi, and he packed essentially his core circle of power with loyalists. So investors are fearing continued strict policies that can hamper growth of tech giants, and there's very few people can challenge Xi's policies, even those that are negative for growth. So, he's in the considered not so great for big tech in China, and you seeing as he again circles his wagons for a third term, essentially, Chinese big tech is suffering, to start this week. It is a segment that we have had our clients avoid for almost a decade now, and will continue to at this point. I don't know if there's much comment on that. Really,
No, I
we've
mean,
just
we already
avoided it.
commented on it before. It's very difficult to really understand the market, the economic system in China. It'd be very difficult to navigate it. I mean, we still don't know where Jack Ma is, right? So you say one thing or be construed as being against government policy, even if it's not, strongly against it or directly against it, and they can essentially just shut down your business. And like they didn't, when Jack Ma spoke out, it was against a specific policy, not that the Communist Party should be in power, but just against one of their economic policies. And it was pretty disastrous for his companies, and for their shareholders, because he essentially disappeared for him as well. But on top of that, his companies got hit with a lot of restrictions. So it's not the type of environment that I would invest in. And this is, with Xi having more power for longer, it's going to continue to go in that direction, it seems, and that's why the market's not happy about it. So
Yeah. And I think I was talking to Brett about this earlier, and he was saying that there was an actual video online where Xi Jinping is, he publicly removes, is it the past
Mhm.
prime
Yeah,
minister?
past Prime Minister Hu Jintao, which was the leader from I think 2002 to 2012 or so.
Yeah.
And it's one of those things where it's opaque. They haven't really given a reason. I think they said he was feeling sick, but in the video, it's very obvious he didn't want to move, and this was essentially the second in command, sort of, in the Chinese Communist Party. There's various factions, and he was the opposing faction compared to Xi Jinping.
Yeah.
And yeah, so he's let out in the middle of the once in a 5-year conference, the biggest really political shift, where they effectively set the next 5 years or decade even of policy for the country. And a former leader in the
Yeah.
middle of it being let out publicly.
Yeah.
It's just a modern day public political purge at that point.
Yeah.
Yeah.
That's how I see it.
Then
exactly.
yeah, and again, one of the reasons why we're just avoiding, even if you look at tech valuations there and they look attractive, it's just we can't, you can't trust the numbers in those
Mhm.
companies, to be honest, and it's hard to get a grip on anything that we'd like to know to investigate deeper into a company like that. That's why it's just an avoidance right now of that, of anything that's listed over there, or even the ADRs that are listed on over in North America that are companies doing business there.
Mhm.
So we'll shift gears. The UK again, once in the news, the bond market rallies after Rishi Sunak became, or looks to be becoming, the Prime Minister of the UK. Now, having served as a Chancellor um, in the Boris Johnson government, I believe Sunak is seen as a better equipped. He's seen as better equipped to address the nation's financial challenges. It's clear that it is a market friendly choice and considered a relatively safe pair of hands in challenging financial times, and the market reacted positively. I wonder, just generally, if we're going to see some governments around the world go back to what are considered more stable, financially sound, leaning parties, and maybe that's what we're seeing here. Maybe that will be a trend. I mean, it tends to happen historically in challenging financial times, so maybe that continues to be a trend.
Yeah.
Something to watch. Now, the final thing we'll touch on, former Bank of Canada Governor Stephen Polo says the central bank doesn't need to crush economic growth to beat inflation. In an interview Thursday, Polo, now a special advisor at a law firm, said that while there will be some painful side effects to the inflation fight, a combination of prudent policy and consideration of the transitory inflationary effects of the war in the Ukraine could lead to a scenario where price pressures contribute to abate without sending the domestic economy into a deep funk. Now, we can comment on that. It may be already well on its way to that deep funk, so I'm not sure if it may be too late. Comments like that. I mean, he has no power in this situation, anyways. But yeah, I mean, you're seeing prices of commodities come down sharply, particularly even just in the last month. That should help with inflation, but it also is an indication that the economy is in trouble too. So
Yeah.
we may already be to a hard landing.
Yeah, and I think
and
that
then
this
another
is
point that some are making is that, though, because the labor market is so tight, that we could actually go into a recession, a technical recession with negative economic growth, but not see unemployment increase, right? Because we're in such a
Which
tight
is
labor market.
unique, right?
It would be extremely unique.
Conditions.
It'd be a very demographic situation where you just
Yeah.
don't have, and it's not, I don't think it's a good situation for the economy long term by any means, but that's largely what the rationale I think is as well. But it just depends how much they have to pound at the economy to get inflation down. I mean, right now I know that food is one of the major contributors to inflation, and that's not something that increasing interest rates is going to fix necessarily. So,
yeah, I went to Burger King the other day and spent $30 on I think two meals. So yeah, I was a little taken back by how much I had
spent
spend.
110 at Churches the other day for the family of five.
Yeah.
So,
Never admit you went to Burger King, Brennan.
What do you mean, Burger
your
King?
first
well,
mistake.
Burger King is owned by
Restaurant brands.
So
It's
it's
true.
a Canadian
It's
company.
true. It's true.
Yeah. They also Popeyes, and I had some Popeyes this weekend too. Maybe I should lay off the fast food.
Yeah.
You heard it here. Aaron's the single cause of inflation, I think. That's what's going on.
You just figured it out.
Maybe I'm not helping as much as I should.
All right, let's look at Innergex, your stock, our take. Aaron's going to answer a listener question on this independent renewable power producer. So let's let you take that away, and I'm going to go grab a sandwich.
Great.
Nobody would know.
You. No, they would not. Okay.
It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Innergex Renewable Energy. So this was from an email from Brian. He asked us to take a look at the company. He mentioned that the stock has been hammered pretty hard over the last year. It pays an attractive dividend, and he wanted to know, is Innergex a buy? So let's take a look at the company and give our thoughts on it. Innergex Renewable Energy, the symbol is INE, trading at just under $15 a share right now. It's a $3 billion market cap company, and it does pay an attractive yield of just under 5%, 4.9%. So what do they do? Innergex Renewable is an independent renewable power producer based in Canada. The company has a portfolio consisting of about 3,500 megawatts of hydroelectric, wind, and solar facilities in Canada, the United States, France, and Chile. So they have a global reach right now, but they're primarily still in North America in terms of the majority of their portfolio. Canada makes up about 51% of the portfolio, and the United States makes up about 33%. Now, the stock has really done very little for investors over the past 5 years. If you take a look at a 5-year chart, the stock price has been actually very volatile. At one point, it had hit a price of $32. That was in early 2021. But over the past 5 years, it hasn't really moved that much. It's come down about 30% over the last year, and right now trading at about 1460. So down by more than half relative to its recent high. And this was during a period where renewable stocks were very popular with investors, and there's a lot of buying in that market. But most renewable stocks right now, particularly the large ones, are going to have stock charts which don't deviate too far from this. Most have not performed well over the last year, although many have performed at least better over the last 5. Taking a look at the company's recent quarterly results, the results looked very strong pretty much across the board. 34% growth in revenue, 34% growth in adjusted EBITDA. Now, earnings per share, even on an adjusted basis, were negative, but cash flow showed very strong growth. 43 cents per share in cash flow for the second quarter of 2022 compared to 24 cents last year. So that's growth of about 80%. And the company has also put out targets for the current year and guidance. They're expecting to grow their production 22%, grow their revenue 25%, their adjusted EBITDA 25%, and free cash flow per share is expected to come in at about 75 cents, also growth of 25%. Points for consistency. So the recent results and the guidance for the year look very strong. But if we take a historical perspective on Innergex, the results are not as impressive. And in fact, one thing that I've noticed, because I have looked at the company several times in the past, is that in spite of the fact that it's an extremely acquisitive company, they spend a lot of money on making acquisitions, they really have not done a good job historically of growing their cash flow per share or their free cash flow per share. So, some volatility, a lot of flatness. We did see, a small amount of growth last year on a per share basis. And then this year, they're expecting 75 cents, as I said, up from 60 last year. So this year, if they're able to hit their targets, growth should be good. But historically, we really haven't seen an established track record of growing on a per share basis. And per share growth is really one of the most important metrics that we look at. Because you can grow your revenue, you can grow your EBITDA, you can even grow your free cash flow on an absolute basis. But at the end of the day, as an investor, you own shares. So if that cash flow isn't growing on a per share basis, you're not likely to get ahead long term. Company does have a 5-year growth plan, which they started in 2021, running out to 2025. So they are expecting to have good, consistent growth over the next couple of years, and they're targeting free cash flow per share of about $1 by 2025, and as well as improvements in the payout ratio and improvements in the debt leverage as well. So that would be about 30% growth over the expected for the current year between 2022 and 2025. Not bad for what's essentially a utility company. Now, one thing that's always come up with me when I've looked at Innergex in the past is the balance sheet. I've always considered them to have a fairly debt-heavy balance sheet, a lot of leverage. This is because they're, on one hand, a utility. It is a capital-intensive business, but they're also very acquisitive, and they use a lot of debt to make acquisitions. So net debt to EBITDA of 10 times, debt to equity of 4.3. I consider that pretty leveraged, although one thing I will say about utility companies, because they have contracted cash flow, they can generally hold more debt and higher leverage ratios than other types of sectors where there's less visibility in terms of the cash flow that they're going to produce over the next couple of years. I also will note that in the past, when I've looked at the company, Innergex's leverage ratios were higher than most of their comparables, which would be independent power producers in Canada and the United States. Although I've noticed leverage ratios tick up in some of the comparables as well. So amongst a lot of the companies that you would consider their peers, you're going to see, relatively high leverage ratios. Net debt to EBITDA 10 times, I consider that quite high. What I would consider to be a more ideal multiple for a company like this would probably be 6 to 7 times. And then valuation based on the current share price, based on the company's targets for this year, you're looking at about 20 times on a price to free cash flow basis. So I don't consider this to be particularly cheap or particularly expensive. It's probably right around fair value in the near term. Now, if they're able to achieve their growth objectives over the next couple of years and generate that dollar in free cash flow per share, the valuation really starts to improve and things look better. But based on their current level of free cash flow, I would say that this is reasonably valued, maybe even slightly more expensive than I would want to pay in this market. So what are the pros and cons of investing in Innergex renewable energy? Well, starting with the pros, we do like the renewable power space, and Innergex has been growing its portfolio. So long term, there's the demand, there's growth in renewable power. It has stable contracted cash flow. So certainly in the event where we enter into a recession, we wouldn't expect a company like Innergex to be impacted nearly as much as most companies in the market. Really high visibility cash flow. Of course, this supports the dividend, sustainable dividend. They have an attractive yield of 4.9%. There is potential that the dividend is going to start to grow again. And the growth in cash flow per share, there was a little bit of growth in cash flow per share last year, and that seems to have accelerated this year. So that's a real positive check mark in the company's favor if they're able to maintain that. That's really what we think Innergex has been missing over the past half decade or so. The cons, that poor track record of growth in per share cash flow. So they really haven't established a track record, while other companies in that space have had a better one over the long term. So although it does appear that that's changing, we can't be completely confident that the company's MO is going to change. There's always the possibility before as they're trying to achieve their 2025 target, that they decide to invest more aggressively in something else, which they then say is going to delay the growth in per share cash flow. So we would prefer to have seen more of a long-term focus on the per share numbers. There's a high dividend payout ratio currently and no recent dividend growth. So their payout ratio, depending on which one you look at, is about 90% of free cash flow. We would consider that high, and no growth really in the last couple of years in the dividend. There's the high leverage on the balance sheet that we discussed, although that's not completely out of line with the peers. And then there's the valuation, not particularly cheap, not extremely expensive, maybe fair value, maybe a little bit above. So finally, what is our take on the company? Well, we do believe that it's a stable company, good renewable power generator, growth by acquisition over time, potentially. We would really primarily own it for the dividend in the near term. If you're going to make the decision to invest in this company, that'd kind of be the base rate expectation, would be getting that about 5% yield, and then hopefully some dividend growth in the near future. They should be able to produce growth over time through their acquisitions. That's still yet to be seen, though, if they're going to be able to hit their targets. Right now, things are looking good in 2022. We would really watch those per share growth figures, though, because as I'd said before, it's one thing to make a target. It's another thing to, make some progress towards that target in a single year. But we have seen it many times in the past where companies have made long-term targets, and then halfway to that target, they've readjusted and they said, you want to know what? We see opportunities to invest more in growth now, so we're not going to worry about the per share numbers. And we don't like that. We want to see the dividend grow, and for the dividend to grow sustainably, the underlying adjusted earnings per share and free cash flow per share have to grow, and not just the overall free cash flow. So Brian's question was, do we consider this company a buy? I think income investors could buy it. I don't think that there's anything glaringly wrong with the company, but I would take a long-term perspective. I wouldn't consider this, a near-term buy. I'd take a long-term perspective on it. Buy it for the dividend, maybe start small and increase the position slowly over time as the company starts to hit their targets. But if you enter in with that base rate expectation, dividend, maybe resumption in dividend growth, then any capital appreciation really just becomes extra. So for me, it's not really a buy recommendation, something that I would want to rush out and recommend as a buy. But for somebody who wants to get a nice dividend yield, it's something that they can consider. But we would just, generally speaking, looking at this right now, we would probably just consider it a hold and something that we would monitor. So that is my conclusion on Innergex.
Good summary.
Good. You definitely more than a summary there. That's awesome.
The summary at the end.
The listener got their money's worth on that one. That's great.
Definitely.
Good. Yeah. Thank you. Appreciate that.
For sure. That was awesome. I wanted to, does anybody have a comments on Innergex, or are we very good? I was gonna say, Google comes out, or Alphabet comes out with its earnings, I believe, either today or tomorrow.
Microsoft
On
tomorrow as well.
Yeah, so
Yeah.
we'd expect with Google uh, very tough comparables over the quarter in terms of earnings last year, and to be down from last year in terms of earnings. Cloud revenue should be up significantly, but slowing the pace that we've seen over the last 4 years. And revenue is expected to rise, but again at a slower pace. Very tough comparables over the quarter last year. But I do think a good deal of that is priced into the stock at this point, considering the fact that it does trade at the cheapest valuations we've seen, basically on an real earnings basis ever. So now let's get to our stars and dogs segment. Brennan, you
But
have a star and a dog this week. The dog is PyroGenesis Canada. We've talked about them before. We've interviewed management. Propel Holdings is your star of the week as well.
yeah, I'll take it away.
From our Stars and Dogs segment, it's time for this week's dog.
So again, the dog of the week is PyroGenesis Canada Inc., PYR on the TSX. The stock is down 72% year to date, 40% in the last month, and about 10% last week. And right now, it's currently trading at about $1.08 and has $187 million market cap. So PyroGenesis designs, develops, manufactures, and commercializes plasma processes and systems in Canada, which are geared to reduce greenhouse gases. It offers its Droserite, a process for enhancing metal recovery, specifically in aluminum and zinc industries. It's PureVap, a process to produce high purity metallurgical and solar grade silicon from quartz, as well as the company provides plasma torches for replacing fossil fuel burners. It offers plasma arc waste reduction systems for waste destruction. As well, the company provides engineering and manufacturing expertise. So, driving the decline is a decline in the company's revenue for fiscal 2022, with revenue down 29% from Q2 of 2021, and both adjusted EBITDA and net income remain negative. Plus, on October 19th, just last week, the company announced a private placement issuing an additional 1 million shares as the company's strong cash balance, which we have monitored for some time now, has now crept into a net debt position in the last quarter of about 6.2 million and is down from a net cash position of 6.7 million in Q4 of 2021. Now, PyroGenesis is a company that we have talked to in the past, actually in California when we were there. And the business looks like it has potential, but considering the decline in revenues, its inability to generate profit, the fact that it continues to trade at 7 times trailing sales, and the need for additional equity raises to maintain the health of its balance sheet, the stock has declined 80% from its 52-week highs and has claimed our not so coveted spot of dog of the week.
Great. So declining revenue, no profitability, and trading at 7 times sales.
Correct. Yes.
Right. So just for perspective,
Get in.
Microsoft is trading at about 7 times. I haven't looked recently, but it'd be around there, about 7 times sales with profitability and a little bit more
Yeah, I mean,
record
it's
in the business.
PyroGenesis, interesting technology, and there is, some blue sky potential in some of those names, or some of the technology they have. I mean, we sat down with management. It is very interesting, but you've been paying a significant premium. I mean, the stock was significantly higher, like Brennan said, and even now you're trading at very high multiples for a company that still doesn't have just consistent profitability or profit.
And my thought here is that if the technology is so great, then we should eventually start to see that in the revenue growth and eventually the profitability, right? So when you look at a company like this, it really maybe becomes a speculation on the technology, but it doesn't appear to me like there's any hurry to jump in. So why not let the company validate that technology through financial performance?
Yep.
Yep.
Agreed.
Okay.
Okay, I will move on to
From our Stars and Dogs segment, it's time for this week's Star.
The star of the week, which is Propell Holdings, PRL, on the TSX. So the stock gained approximately 19% in the last 5 trading sessions and is up about 18% in the last month. Although the stock is still down about 35% year to date, but it has performed well in the last week, which has made it our star. So right now the stock trades at about $8.60, has a $286 million market cap and a yield just over 5%. Propel Holdings operates an online financial technology company, or fintech. The company's online lending platform facilitates access to credit products such as installment loans and lines of credit under the MoneyKey and Credit Fresh brands to American consumers. It also offers marketing, analytics, and loan servicing services. So what's driving the share price gains this last week? Well, it is the recent announcement on a 5-year agreement to become the primary lending service partner with a subsidiary of Pathward Financial, which trades on the NASDAQ under the ticker symbol CASH, or cash on the NASDAQ. So the 5-year renewable agreement contemplates fee income for Propell by providing white-labeled technology and service solutions for Pathward's consumer lending capabilities, including customer acquisition services, loan management software, risk and response scores, and credit servicing capabilities. So Propell expects the program to launch by Q1 of 2023 and to be accretive to revenue and net income in 2023, with financial impact growing into 2024. So obviously the market likes this news, but the company did note that they will release more details in a future financial outlook for guidance. So we can look or wait for that eventually, which management will provide. So fundamentally, the business has been performing well, with revenue up 90% in Q2 of 2022 over Q2 of 2021. Net income was down about $500,000 to $2 million. And on a trailing basis, the company trades at approximately 48 times earnings. But it would be nice to see the company come out with their updated financial guidance so we can just kind of get an idea on the forward valuation here, especially with this new agreement that they had just signed. And as well, just looking at the balance sheet in Q2, the company had a net debt balance of about $67.4 million on its balance sheet. So although the stock is down 35% year to date, its recent positive news and strong share performance over the last week has allowed it to claim our coveted status of Star of the Week. So yeah, there's not too many stars out there, but I thought it was a decent company to look into. It actually happened, oddly enough, where we did get a question on YouTube on the weekend, and I already decided to cover it as a star before I even saw this comment. So hopefully that listener is listening right now and kind of gets my take. And he did just kind of compare it to GoEasy a little bit. He said that it was a mini GoEasy, essentially, which is a company that we are familiar with, especially Aaron is familiar with GoEasy.
Yeah, of course. That's where what I would say is the closest comparable. So the differences between GoEasy and Propell, one is that GoEasy is considered omni-channel, so they have an online applications where you can access their financial products. You can also do it in person, whereas Propell is 100% online. Propell is mostly US, expanding into Canada, whereas GoEasy is Canada. So some differences to the business, but GoEasy certainly much more established company in terms of track record, great growth, much better performance on the bottom line, certainly. If you want to just take a look at Propell, I mean, we sat down with the CEO of Propell when we went to the what was the event that we went to in Los Angeles?
I think it was the LD Micro. Was it
No,
the
it
LD
wasn't the
Micro
LD
or the
Micro.
Roth?
The
Roth
Roth conference.
conference.
Yes, it was the Roth. So
Yeah.
we sat down with him at the Roth. We've read the company's releases in the past, their targets. They've made a lot of very aggressive targets in terms of growth, in terms of earnings growth. For me, I still think it's a wait and see story. I'll just give you just an example here. So just in the last quarter, they grew their revenues 90%, yet operating income was flat. So 90% growth in revenue, no increase in operating income profitability, and then earnings per share, earnings down $2 million compared to 2.4. There may be some things we can adjust out of there as well. But the number of shares up 30%, right? So this is, so far what we've seen is a lot of great activity on the top line, but that not funneling through to the bottom line. And I know that they said that when they grow, when they make a lot of new loans in a quarter, it's great for the revenue growth, but it impacts in the near term, short term, it impacts their profitability. So that's fine. But this is another example of how long you're going to let that continue. Are you going to just keep growing revenue at this, 40, 50, 60, 70, 80% plus mark, but then not generate profitability on the bottom, or growth and profitability on the bottom line? Until we start to see those earnings move up, it's, to me, it's still a wait and see story.
Yeah. Awesome.
Okay, well, now we can get to hitting our mailbag, and we're going to go to a listener question. Brett's going to answer that on Nuran Wireless Inc., symbol NUR in the CSE.
For my favorite part of the show. What's that say? Talk to the audience? Oh, God, this is always death.
All right. So we were sent in a question from Christian about Nuran Wireless, and they were wondering if it could be a potential disruptor, and they compared it to BlackBerry or Shopify. Nuran Wireless is down 53% year to date and is currently trading at 64 cents on the dollar under the symbol NUR on the Canadian Securities Exchange. The company's product is Networks as a Service, or NAS. The company's researches, develops, and manufactures cellular network equipment, specifically radio access network equipment. The company is based out of Canada, but its primary operations are in Africa, including in Cameroon, the Democratic Republic of the Congo, and has recently installed its first site in South Sudan. As well, it has existing contracts for Namibia. I cannot talk right now. Sudan, the other Sudan, they split off in 2011, the original one. And then more African nations they are looking to expand into Latin America in the future. The company is currently not profitable, so to evaluate the company, you need to compare the potential versus the potential risk and the current risks. The company offers an extremely cost-effective way for rural and undeveloped regions of the world to access cellular networks. Nuran has a goal of achieving 10,000 sites by 2026, of which it currently has contracts for 4,124, and the company has current live sites of 101 and expects 400 of those sites to become live by the end of the year. Some rough math, so not exact by any means necessary, but it's good to gauge the overall growth trajectory. Using the midpoint of the two most recent contracts, the average per revenue per year site is 20,000 US, which would mean by 2026, and if the company is able to hit its goal of 10,000 sites, it would result in a forward yearly revenue of 200 million US, which is quite high, to say the least, for a market cap of 21 million Canadian. But this is because there's significant risk embedded in the company's operations. Nuran is operating in high-risk countries like South Sudan, which was in a state of civil war from its initial sovereignty in 2011 to 2022, with intermittent clashes still ongoing between the various groups. Severe conflicts can and will produce negative externalities, causing corporate operations in the area to be hindered and completely stopped in some cases. Whether something like this will happen and hinder Nuran is just speculation, but being conscious of the regional risk is important. Another significant risk is counterparty. Currently, the lion's share of Nuran's planned expansion is attributed to two contracts with two companies, MTN and Orange, and their various subsidiaries. If either of these companies has its own issues or relationships between them and Nuran break down, the growth of Nuran would be significantly slowed. Nuran is also needing to raise capital for its own operations, as it does not have actual cash flows to cover the current initial building and operations of these sites. It has access to some funding from public development funds, including the European Investment Bank, which is beneficial, but the company may need to dilute equity more, which it has in the past, if it is unable to acquire external funding. And lastly, just on a note on Christian's disruptor comment, I wouldn't call them disruptor, as they aren't really disrupting anything. They're building up something new. But I would call them an innovative company, just not disruptors, at least of yet. And I'll open that up to you guys.
Nice.
Yeah. Yeah, it's good. I mean, I'm reading through, they announced, it says a 5-year NAS agreement, $75 million contract. But if you just go down a little bit, it talks about the agreement is expected to be the company's second largest in terms of number of sites, with the potential to generate over 75 million in gross revenues over the course of 5 years. So it talks about 75 million, but it's the potential is there to do that. So, we monitor it. It's a big headline. Will it actually? I mean, we know it. I think in the last quarter, what did they do in terms of revenues? It was in the
300,000 or 230,000. Yeah, not much.
Yeah,
They're very choppy though.
right?
Yeah, they're choppy.
Yeah, so it can be. I mean, for the 9 months, 2.1 million, but still on the 9 months, still losing 5.5 million. So, again, it's something we have to watch. If they can start to transition towards profitability, it certainly, starts to pique our interest. But, we can't, you don't see that in the numbers right now. The contract looks promising, but again, it has the potential to generate 75 million. I think some people see the headline number and think, well, it's 75 million over 4 or 5 years. We can book that and start modeling that. It doesn't always work that way. Often
I'm
it
sure
doesn't.
whoever wrote the headline had that in mind.
Yes, of course. So I mean, it's certainly interesting. We're continuing to monitor it, but that's a good, picture of where the company is right now financially and your risk to reward type scenario. There certainly is high risk there. If they could hit those numbers and get to those revenue targets, I mean, it would be something that would certainly be interesting. But there's a long way between now and getting to those numbers.
Yep.
I think that's going to close out our show for this week. We encourage you, if you want to, those tickets are going fast for the live webinars and for the VIP package event that we're having in person. So get those tickets. We'd love to see you there. I can't see, but smash that subscribe button. I'm not even there, but I'm pointing down right now. Smash it. Keep your questions coming into our Your Stock, Our Take segment. We'll keep answering those questions on a weekly basis. Rate and review us on iTunes. We'd appreciate you doing that. And we'll keep putting out the content on a weekly basis here. I'd like to thank everybody out there and wish everybody profitable investing. Thank you.
Thank you, everyone.
Thank you.